Okay, Grandad, so on the last episode number 2 of the Investment Hound podcast, we discussed some of the core principles of investing that investors need to know. We also looked at how to judge markets and what to look out for in a stock. So to start us off this week, and given that they play such a central role in your investment strategy, I want to dive into the whole area of dividends. So let's start with the definition of a dividend. Why are they attractive, and where do us beginner investors find good companies that pay dividends?
Well, a dividend is money that you receive into your bank account or in cash by check, through the post. So what it is it's a share of the profits. So in other words, a company, when it actually makes a profit, it generates cash. So if you have a car and it costs you 20,000 and you sell it for 27,000, there's 7,000 of extra cash in your bank account. So when a company makes a profit, cash goes into its bank account. It then has a decision to make. Does it release some of that cash and pay it over to the shareholders? Or does it keep it in the business? So at the annual general meeting, the shareholders are asked to vote in favour of a dividend. The board of the company makes a recommendation, and then the shareholders vote yes. Shareholders, you can imagine, will rarely vote no to a dividend because cash is king.
Mm. And what do you look out for then in a dividend? What are you looking at?
What you're looking at is to try, it's a bit like getting interest from your bank deposit account. In other words, what is the share earning for you as distinct from what is the share earning for the company? So if you put your money into the bank and you get 2 or 3% interest on it, if you put your money into a share, given that a share is less certain in terms of delivering you a return than a bank deposit account, which is guaranteed, you would look for something more than the 2 or 3% you get from the bank. So what I do is I look and see what percentage of my money has been paid over to me. So if I had a bank deposit account and I had $1,000 in it, and the bank was paying me 3%, well, 3% of $1,000 is $30. So if I have a share that costs me $1,000, I'd be looking for maybe 5%. So I'd be looking for a dividend of $50. So a dividend, that is called a dividend. And then there's a thing called the dividend yield, which looks at the market price of your share and compares the dividend that's being paid to you as a percentage of that. So I look for dividends that provide me with a good percentage of each year. And you can find those anytime you want to by just, Googling it in Google and say, what is the dividend yield on a particular stock? And they'll tell you.
Mm. Yeah, I do remember you saying that you rely on the dividend income year after year, especially if the company pays out no more than 50% of the profits to the shareholders. But could you remind us again, Grandad, why do you think that companies with a payout ratio of less than 50% are likely to increase in price?
Well, first of all, why do company share prices rise? Well, let's say that you have a shop on the main street and you're selling goods in the shop and you make a big profit. Well, you then take some of that profit and you get another shop. So now you're making even more profit. Mm. And then you take some of that profit and we'll say you buy a shop in another country or another city. Now you're making even more profit. So long as the company is investing some of its profits in the company and growing the company, then the chances are that the earnings or profits of that company will rise. And if once the earnings of the company rise, well, then the share price will rise. So share prices will rise if a company is well established in its markets, knows how to do the business, and has money to increase its shops or its outlets or whatever, build new systems or buy new other companies or whatever. Over time, you'd expect the shares to go up. Now, they mightn't go up between Monday and Friday, but, if you look at the shares over a 3, 5, 7-year period, and they are well-run companies that know how to make money from the business they're in, and they're increasing the number of places they're doing that business, well, then the share prices will rise.
So it's like if they have enough for future reinvestment.
Well, the point is that if they pay out everything every year in dividends, then they don't have any money to get an extra shop or whatever. So there's a balance to be struck between how much money they pay out in cash to the shareholders and how much money they retain in cash to invest in the business.
Yeah.
And when I started must be about 15 years ago, when I started seriously investing in the market. When I say seriously investing in the market, I should say regularly investing in the market. I'd be looking to see what percentage of the profits are retained in the business and what percentage of profits are given out by way of dividends. And in those days, in Ireland, for example, the banks were one of the companies that actually paid out a good percentage of their profits and dividends. They paid out up to 40%. Whereas many other businesses, many of the manufacturing type businesses paid kind of 30% or even 25%. So I'm happy if to be getting 40% and 60% then being reinvested in the business. However, since I started that, and at that time, by the way, I was looking to invest in businesses that had at least a 3.5% dividend yield. Then I discovered that over the last 15 years, the practice of companies now is to pay out more than 25 or 30%. In fact, the banks are still paying 40%, but many, many companies are paying 50%. And therefore, I think 50% is closer to the new norm, that in other words, half the profits are paid out by way of dividends and half the profits are retained in the business for future expansion. So once they don't go to 70 or 80%, that would be starving the business of future investment. There was one company here, a well-known newspaper group, and it was controlled by a very rich man who had three massive castle-type properties in Ireland. He had a property in London, he had a property in Paris, he had a property in the Caribbean. He had a property in New York, and I think he might have even had one in Pittsburgh. And he had properties in South Africa and properties in Australia. So even though he was a wealthy man, he had very high overheads. So what he used to do to make life easy for himself was he got this newspaper company to pay out 85% of their profits by way of dividends each year. And of course, he was a big shareholder. So he got big cash dividends, and that paid for all his properties and so on and so forth. Then what happened was we had the financial crash. Now, one of the things that capital is required for is what we would describe here in this country as rainy day money. In other words, you have to have some way that when times get tough and you're running short of money, you can call somewhere to get some rainy day money. And that's a function of the capital that you have in the business. And of course, this newspaper company, because it was dishing out 85% to its shareholders, and the other 15% was obviously being spent to keep the business going, when the rainy day came, that company was unable to survive. So you do not want a company paying out too much profits by way of dividends, because it's starving the company of investment and it's starving a company of rainy day money just in case you need it. Okay.
So 5 or 6% minimum with a minimum payout ratio of 50% is an indication that it's sustainable.
Yeah, and that
Okay.
that the yeah. Yeah, in other words, the dividend yield is no more than 5%, maybe 6%. But once you go above that, you're taking a risk that, in fact, it's not sustainable. And given that I'm a pensioner, you see, one of the things, and you're a long way, Adam, from being a pensioner, but one of the things that happens is you're earning money. Let's say you're earning a salary of 100,000. When you retire, you do well to be on a pension of 50,000. So what happens to you if you're living a nice lifestyle on a salary of 100,000 and suddenly you now have only 50,000 coming in? What are you going to give up? What goodies are you going? Are you going to stop playing golf? Are you going to not go on holidays 3 times a year, or whatever it is that you've decided to spend 100,000 on? But if, on the other hand, when you're saving for the long run to get plenty of dividends hitting that bank account, maybe you can make up what you've lost when you become a pensioner by having dividends coming in if you're at it long enough. So for pensioners, for example, dividends are extremely important.
One thing that I hear, or two things that I hear come up on the Financial Times and in Bloomberg and stuff like that when I'm looking at it, is these concepts of growth stocks and value stocks. So let's have a little chat, Grandad. What is it? What is the difference between a growth stock and a value stock?
Well, we'll start off with the growth stocks. The growth stocks are stocks, the price of which are rising through, they're breaking every possible rule that you might have of a 2 or 3 or 4% gentle rise in the share price. They're the next new thing coming through, and they're booming. Their profits are booming and their share prices are booming. So there are people who like to invest in what they would describe as winning stocks. And so they invest in stocks that don't necessarily pay high dividends, because the stock price is increasing so quickly that if you need money by way of a dividend, you can cash in a few shares and go away on your cruise with the proceeds of what you've cashed in, right? So that's one type of stock. And the other type of stock then is value stocks. Value stocks are the stocks which, typically speaking, they'll go up by 2, 3, 4% per annum average over the years, right? So you're getting a 2 or 3, say you're getting a 3% return on the share price over each year going forward, right? But on top of that, let's say they're paying you a nice fat dividend of, say, 5%. So that stock is giving you a steady 8% every year. The growth stock, in the years in which it's growing dramatically, could be giving you 20% per annum. So a lot of people take a risk on the growth stocks. The problem with growth stocks is that they eventually falter and they're reeled back into the pack, much like in the Olympics. You know, when you saw the cyclists cycling, and somebody was in the front and they were cycling ahead of everybody else, and then eventually the pack caught up with them. And they're reeled back in by the pack. Similarly, if you have a new software program which is better than any on the market, and your shares are growing by 20%, at some stage somebody's going to produce a software program that can compete with your software program, and then somebody else is going to produce another one to compete with both of those, and so on. So eventually you lose that edge that you have. But while that is taking time, you can make a lot of money out of growth stocks. Whereas with value stocks, it's just business as usual, gradually increasing, paying you the dividend and so on. Now, I have an example here of 2 stocks. A growth stock would be a stock like Microsoft. And a value stock would be a stock like the German insurance company Allianz. Now, the dividend yield for Microsoft, which is quoted in the NASDAQ, which is the technology part of the New York market, they're paying a dividend yield of 0.73% per annum. Whereas Allianz is paying a dividend yield of 5.7% per annum. The payout ratio, Microsoft payout roughly 25% of their profits. So they're very conservative. They invest, in other words, 75%. Because the technology world is changing so quickly that what makes sense in terms of a new software program this year could be out of date in 2 years' time. So they are anxious to pump 75% of their profits into new products and services and software to keep the edge. Okay? Allianz, on the other hand, whereas I said to you, Microsoft pay out 25% of their profits, Allianz target 50%. In the last year, they paid out 54%. Well, it's thereabouts. 50% they target, okay? So they don't have a problem paying out half because the business they are in is almost, it's not quite static, but it's not as fast moving as the technology business, which is a relatively new business to the world, whereas insurance has been around for hundreds of years. And then there's another concept called the beta.
Okay.
And the beta is a measure of the volatility of a share. So let's say, for example, you're saving for a new car and you want to save 50,000. So let's say you put 50,000, well, let's say you put 35,000 into stocks over a 5-year period. And let's say at the end of the 5 years, you're expecting to have 50,000, okay? If the stock has a high beta, that means that it's very volatile. So what beta means is, beta is the second letter of the Greek alphabet, and alpha is the first letter of the Greek alphabet. If you buy a share, you take what's known as alpha risk. You take a risk in what you buy. If you invest in the stock market as a whole, you are not investing in any one individual alpha stock. You're investing in all the alpha stocks, in other words, in the market. That's called beta. Beta is defined as 1. So what that means is they've looked at how the market has moved over the last, say, 5 years, month by month, and they've done out what they would describe as the standard variability of the market. The market sometimes goes up, the market sometimes goes down. Okay? And so let's say the market on average is growing by 8% per annum, okay, or falling by 8% per annum. But overall is fairly, or say falling by 5% per annum. So overall is growing by say 3% per annum, okay? Then that's the beta of the market. But the stock that you have, like Ford Motor Company, has a beta of 1.25 or something like that, which means that if the market rises by 10%, Ford Motor Company stock would be expected to rise by 12.5%. Because, it's 12.5 versus 10, okay? So the beta shows you how much of the market goes up by, but for the individual stock, it shows you how it moves differently to the market. So for example, for Microsoft, I just took it out, okay? The beta for Microsoft is 0.89. So in other words, say it's 0.9. So if the market rises by 10%, Microsoft is expected to rise by 9%. Okay? Do
you think that's good or bad, or what's like
an
indicator that we should...
I'll come back and give you the lessons from beta in a minute, right?
Okay.
I just want to give you the Allianz. The Allianz beta is 1.08. So Allianz will move slightly more up or down than the market moves up or down, whereas Microsoft will move slightly less up or down. Now, you have stocks which will move by 1.5 times what the market moves by, and you'll have stocks that only move by half of what the market moves. So if you have a stock which moves by only half of what the market moves, if the market goes up by 10%, your stock goes up by 5%. Or if the market falls by 10%, your market only falls by 5%. Okay? Now, the significance of that is that if you're saving for 5 years to change your car, and you happen to want to buy the car when the markets are down low, and your stocks that you've bought are higher beta than the market, in other words, let's say they're 1.5, well, you're going to take a big hit if you have to sell at the wrong time. So depending on how soon you want to sell your shares would depend on how comfort level of beta you should have. If you feel you're going to sell the shares in the next few years, then you should get a beta close to 1. But if you feel that you're saving, we'll say, for your kids' university education in 15 years' time, you don't have to worry about getting the beta down closer to 1 until you come close to the 15 years.
Okay, interesting. So let's just do a little recap there, right? Growth stocks tend to have higher growth rates than the market, and they usually pay out much lower dividends as the investors believe that the increase in the share price will compensate for the loss of the dividend income. And the example you gave for growth stock was Microsoft. And then a value stock tend to be steady. It's just business as usual. And they tend to pay out good dividends, which can be suited for someone like yourself who have like a dividend income strategy and are more suited to like longer term investors as well. And then beta is a measurement of the market volatility, which means that if you have a beta, as you just said there, of 1.25 and the market increases by 10%, your stock should increase by 12.5%.
That's correct. Yeah.
Okay.
That's correct. So effectively what you're doing there, right, is you have to first of all know when you're going to invest, when do you want your money back? And the longer you can leave your money in the market, then the more likely that your shares will be worth more. On the other hand, if you have high beta stocks, don't hold high beta stocks close to the time that you know you're going to be selling the shares.
Okay. So, Grandad, how do we know, or what type of shares have a low beta?
Yeah, but the type of shares that have low beta are shares that have very predictable earnings, that you know for certain what kind of a performance they're going to have next year and the following year and the following year. And the most common form of shares that have low betas are defensive shares. The examples of defensive shares, for example, if we take the pharmaceutical industry, people have to buy their medication all the time. It doesn't matter whether the economy is booming or the economy is not booming. Granny needs her medication. So defensive shares, which we probably will need to cover next time round, are shares that have low beta. On the other hand, cyclical shares, which perform very well when the economy is booming and not so well when the economy is not booming, they are very high betas because they have a spread between the good times and the bad times that defensive shares do not have.
So maybe
the defensive shares are the same the whole time.
So maybe then growth shares tend to be cyclical and defensive tend to be value?
No, growth shares don't tend to be cyclical because they're booming anyway.
Okay.
You know, like there's a share called NVIDIA. And NVIDIA produces the computer chips for AI. Artificial intelligence, right? Which is the coming thing, as to say, right? That share price has gone up by hundreds of % in the last 3 years, 4 years, right? So that share is going to continue as businesses are grappling with artificial intelligence and trying to build artificial intelligence to cut down on the workflow that they currently have to take, right? So that share will go until other companies actually start to build the same chips that NVIDIA have.
Okay. Well, we can discuss it in further detail anyways in our next podcast.
I think so.
Okay.
I think so.
So then just to finish up this week, Grandad, we got our first question from a listener called by the name of Circa, who said, really enjoyed your first podcast. I would love if you could answer if it's worth investing in the S&P from tax perspectives, or are we hit with double tax on it? Also, how can we invest in it without going through a financial advisor? Thanks. Well, thanks for the question, Circa. What's your response to that, Grandad?
Well, first of all, countries have what they call double taxation agreements. And Ireland has a double taxation agreement with most of the developed world. So they have one with, for example, the US. They have one with the UK. They have one with France, Germany, and so on, right? So they have double taxation agreements. And what double taxation agreements effectively allow is that if I have to pay tax in the US on something, and I also have to pay tax in Ireland on the same thing, the Irish government agrees to take into account the American tax. So let's say we pay 100 of American tax and the Irish company is looking for 140. You will now only have to pay 40 in Irish tax. So in other words, you have a double taxation agreement, and it applies in America as well, a double taxation agreement. And most developing countries have that. So there is no significant double taxation between the US, UK, France, Germany, and so on, and Ireland, and vice versa.
So
now,
if you were to invest in the S&P 500, let's say you put $100 in it, or it was worth $100, and then you withdrew that, how much tax would you have to pay in that then, in Ireland?
Well, in Ireland, you pay on whatever the gain is. In other words, if you put $100 into the S&P, and when you sold it, it was worth 10 in profit, you'd pay capital gains tax on the 10.
Oh, okay, that's good.
No, you wouldn't have to pay it in America. But if for example, you had dividends in a company in the US, the company in the US would withhold tax, okay, and give you a net dividend. Well, you wouldn't have to pay that tax on that on what you took home, because you've already paid it in the US. So all I'm saying is that dividends are more complicated, but at the end of the day, you don't pay tax twice, unless the rates are terribly different. You know, in other words, unless if you've paid more than the Irish government want you to pay, they won't give you a credit back because you've paid more in the United States, but they won't tax you twice. Does that make sense to you?
Yeah. So
now,
you won't be hit with double tax. You're only hit with one tax payment, is it?
Yeah.
On what you earn. Yeah.
And the other thing then is that she asked, what about, does she have to go through an advisor? I think what she means by that is, if she wants to buy the S&P, does she have to go through a platform, to buy it? I mean, you bought it. What platform did you use?
Trading 212.
Yeah. So she would have to go through a platform. It could be any, there's loads of platforms.
Yeah.
For her to find out what the best platform for her is, she should ask the people that she knows that buying things like that, what platforms they use. Because if I told her what the best platform was today, it mightn't be the best platform tomorrow. So she's better off talking to people locally and finding out what they think is the best platform. But you have to go through a platform to access the market. Now, if you were going to invest a lot of money in the market, you'd be better off going to a professional advisor who will help you to pick out what you're going to go into the market for. But if you're only investing a few thousand in the S&P, there's no need to go to a professional advisor. But you do have to go to the computer platform that will put the transaction through for you. Like your one was what called again?
Trading 212.
Yeah.
And your one that you use is Davies, isn't it?
Davies Stockbrokers, which would probably be more expensive. But I've been using them for decades. I'm not going to change.
Yeah. And that's the thing. The only reason why I use Trading 212 is because that was one of the first ones that came up when I Googled them. When I Googled on them, what platform to use. But I know a lot of people now are using Revolut as well. Revolut.
Oh, they are. And there's eToro is another one, which is a big one.
Yeah. That was an email we got off another guy as well who asked
That's right, Peter,
what do you think of eToro.
And eToro is a huge company. So it looks okay, but I don't use them. So how would I know what all the other platforms are doing if I don't use them?
Yeah, I think eToro though is more for intraday trading. I think. I don't think it's for. I don't know.
Well,
if
I
it's for
think
long-term investing.
like when you buy a share, if you're a trader, you're probably going to sell it in a day.
Yeah.
Okay.
Yeah.
But if you buy a share, you don't tell the trader, by the way, the platform, by the way, I'm going to sell this before the day is out. So they don't know whether you're a trader or not. Now, maybe that a lot of traders are using eToro, but in fact, eToro is agnostic as to whether or not you're a trader or a saver.
Yeah.
They just have the equipment to enable you to get to the market to buy or sell.
And one thing that's also important to note, Circa, is when you're choosing your platform, they all charge different fees. So I know for Trading 212 charge relatively low fees, because they're not for massive accounts. Like I only have a couple thousand put in the Trading 212 account. So they charge me for every €50 I invest, they charge me 35 cents. So it's like 0.7% is what the commission fee is. But I think Davies charge a good bit more.
Well, I think they charge a bit more, all right, yeah. The old established platforms will always charge you more than the new guys who are trying to muscle in.
So that's also worth noting as well, is just to check what the commission fees are on the platform you're using. And I know Revolut have a different fee then as well to Trading 212 and Davies and eToro and Oldham or whatever. So
and Good Buddies is the AIB old stage platform. So,
and just on this quickly, Grandad, one thing that's also important to note is the level of security you have around what platform you use. So I know one thing that you told me is to check what central or what government body is Trading 212 backed by. And Trading 212, I believe, are like the Central Bank of Lithuania, isn't it?
No, that's Revolut.
Oh, that's Revolut. I think
I've worked in Lithuania, in banks in Lithuania, right? All I'm saying to you is that I had more confidence with an Irish one because I'm in Ireland.
Yeah.
But that's pure prejudice, you know?
Yeah. So that was also something to note as well. So. Okay, well, that's probably us for this week, Grandad. I thought it was great to get a question.
Oh, yeah, it is. Yeah. Well, people are starting to ask us questions now. We can't really give very detailed advice because we'd have to get central bank permission to do that. All we can do is help you in a general sense and give you some feeling for what we've done so you can learn from our shenanigans.
Well, not yours. I know nothing. Someone actually commented, Grandad, you might be interested to hear this, right? Someone actually commented on our TikTok there the other day, and it was like, it was a video of me. Now, it was actually of both of us, okay? But I was at the beginning just saying, and this is what I said. I was like, so the S&P has increased this much and NASDAQ has increased this much. So what do you think about this? And someone commented under, don't take financial advice from someone still living with their mom. As in about me though, because they obviously didn't watch the whole thing or something like that and see you in it. But yeah, I'm not giving advice here. I know nothing. That's what I'm trying to say anyways. You know,
I know nothing. I'm
only the student. All right. That was a good one, Grandad. I was happy with that.